Hello, thank you for joining me today. My name is John de Carvalho, and I'm the Chief Investment Officer for Moss Adams Wealth Advisors. And the presentation that I'll be giving today is the 4 most important things that investors need to know for 2016. With that, we'll get into the disclaimers here. The topic I'd like to address here that we've heard from many investors is, what does the future for global equity returns look like? And will they be similar to what we saw prior to 2015? We think that 2015 could be an inflection point in the global equity markets. Prior to 2015, we had a 7-year period where U.S. stocks dominated international stocks, as depicted in this chart. The blue line is the S&P 500, and the yellow line is the FTSE All-World ex-US. So those are all international stocks. And you can see by the spread between the blue line and the yellow line how much more the US market has gained versus international markets. However, prior to 2007, international markets outpaced US stock markets. So what can we expect going forward? Well, 2015, the reason why we think it could be an inflection point was, for most of the year, international stocks were outpacing U.S. stocks by a wide margin. As we closed the year, the gap was narrowed. However, if you look at various regions in the international equity market, we think they're poised to outperform the U.S. from a valuation standpoint and an earnings growth standpoint. You'll see that once international equity starts to outperform U.S. equities, they outperform for a long time, and they outperform by a nice percentage spread. This chart shows that when international outperforms, it's on the top. When U.S. outperforms international, which is depicted on the bottom. These periods usually last anywhere between 5 to 7, upwards of 10 years, and they're persistent. The jagged lines indicate some of the fits and starts that they initially go through, and you'll notice at the beginning part of the period, that spread isn't as wide as what you get towards the mid part of the cycle. We think that 2015 represents perhaps that inflection point where we're seeing a turn more towards international stocks. One is the European Central Bank just embarked on quantitative easing, which is reminiscent of what the U.S. Federal Reserve did in 2009. And the Bank of Japan has been full steam ahead with their quantitative easing, actually doubling the program in late 2014. So what you have there is a situation where their economies don't look very good from a data standpoint, but earnings growth looks very good, and we could be set for a period that international outperforms. This last slide that I'll show just shows you the average 12-month rolling return when international stocks outperform domestic. And what you'll see here is, in the dark blue bar in the middle, is that when this starts to happen, on average, international large cap stocks outperform domestic by 8%. International small cap stocks outperform domestic stocks over 12 months by an average of 14%. These are very powerful numbers. However, with interest rates being very low, we would again caution investors to temper their expectations on reaching those averages. We think that international will outperform, and the period will be sustained over 3 to 5 years, but the magnitude might not be as great as what we've seen in the past. With that, I'll end my presentation, and thank you all for joining me again.